Hidden gems. 3 undervalued sectors and the best dividend stocks. The stock market is not efficient. Billions of dollars of value are hidden in sectors the media ignores. This is your chance to buy low and earn high. We are revealing 3 critically undervalued sectors and the best dividend-paying stocks you must own to build a reliable, monthly, passive income stream and get you more money. Welcome back to More Money. We have covered the essentials of cutting costs and maximizing your tax savings. Now, we are shifting focus to pure portfolio construction. The biggest mistake investors make is chasing headlines. They buy high and sell low. The secret of successful investing lies in recognizing undervalued sectors before the crowd does and positioning your portfolio to benefit from 2 things: capital appreciation, the stock price going up, and consistent dividend income. Today, we are going deep into value investing and income generation. We will analyze 3 major sectors in the U.S. economy that show significant signs of being undervalued, and we will highlight specific dividend stocks within those sectors that offer attractive yields and stability. This is your blueprint for turning saved cash into a powerful, automated income stream. Sector 1. Regional banking and financial services. The interest rate play. While the megabanks dominate the news, regional banks and specialized financial service companies have been heavily penalized by market fears over commercial real estate exposure and fluctuating interest rates. This fear has created a massive buying opportunity. Regional banks are essential to local economies, providing small business loans and community financing that the national giants often overlook. Why they are undervalued. The market is pricing in the absolute worst-case scenario regarding loan defaults and regulatory pressure. However, many regional banks have diversified loan portfolios, solid cash flows, and are trading at low price-to-earnings, or PE, multiples, often below book value. The dividend strategy. Regional banks historically pay strong dividends. We look for institutions with a long history of raising their dividend payments and a healthy payout ratio, meaning they are not paying out more than 50% of their earnings as dividends. Investing in regional bank ETFs or well-capitalized individual regional banks provides exposure to a core sector of the U.S. economy that is priced for failure but positioned for recovery. This is a classic value investment with an income twist. Sector 2. Managed healthcare and specialized pharmaceuticals, the demographic shift. The U.S. population is aging rapidly, creating a guaranteed, unstoppable demand for healthcare services, specialized care, and pharmaceuticals. Despite this fundamental demand, many non-hospital healthcare management companies and pharmaceutical firms have experienced price suppression due to government regulation fears or patent cliff concerns. Why they are undervalued. Investors have often rotated out of these sectors due to political noise surrounding drug pricing and policy reform. This fear presents a chance to buy essential services at a discount. We are not looking for risky biotech startups. We are looking for established companies providing necessary services, such as health insurance providers, dialysis centers, or medical device manufacturers. Their services are non-discretionary. People cannot stop using them. The dividend strategy. Healthcare is a resilient sector that generates massive, consistent, free cash flow. This makes them excellent dividend payers. Look for companies in this sector with a high barrier to entry and strong patent protection. Investing here gives you a predictable, defensive stream of passive income, shielding your portfolio from broader economic downturns as healthcare demand remains constant. Sector 3. Materials and infrastructure. The physical economy. The move towards reshoring manufacturing, rebuilding aging U.S. infrastructure, roads, ports, water systems, and the massive need for renewable energy components require one thing: raw materials and physical construction. Companies that mine, process, or manufacture base materials like cement, copper, or specialized chemicals are the foundation of this physical economy. Boom. Why they are undervalued. These stocks are often cyclical, meaning their prices follow the overall economic cycle, leading to periods of undervaluation during market pessimism. They are currently facing headwinds from global trade uncertainty, but the long-term domestic demand for infrastructure is massive and government-funded. Investing in this sector is a bet on the physical rebuilding and industrial renewal of America. The dividend strategy. Materials companies typically thrive during periods of high demand and low inventory, allowing them to pay generous dividends during upswings. Furthermore, many infrastructure-related companies, such as utility providers or specialized manufacturers, operate under regulated, stable revenue models, making their dividend payouts highly reliable. Look for firms with long-term government contracts that guarantee revenue stability. The golden rules for dividend investing. To ensure your passive dividend income is sustainable, you must follow these 3 simple rules. Analyze the payout ratio. Never buy a stock where the company is paying out 70% or more of its earnings as dividends. A high payout ratio indicates the dividend is unsustainable and will likely be cut during a downturn. Look for payout ratios between 40% and 60%, which allows for reinvestment back into the company's growth. Look for dividend growth. It is not just about the current yield, it is about the dividend growth rate. A stock yielding 3% but increasing that yield by 10% every year is far superior to a stock yielding 5% but never increasing it. You are looking for companies that consistently share their increased profits with shareholders. Avoid yield traps. A stock with a suspiciously high dividend yield, say 10% or more, is often a yield trap. The yield is high because the stock price has recently crashed due to existential company problems. The high yield is usually a warning sign that the dividend will be cut soon, resulting in both capital loss and loss of income. Gancho para o próximo video. You have learned how to find hidden value and how to generate passive income through dividend investing. That is a fantastic start. But what if you could create an entirely new stream of passive income, divorced from the stock market and leveraged entirely on your own skills and time? In Video 3, the final part of our Money Mastery series, we will move beyond traditional investments and show you how to build highly profitable passive income streams through digital products, real estate, and automated systems. The ultimate engine for accelerating your financial freedom. Which undervalued sector are you most excited to research? Share your strategy with me in the comments below. If you are ready to learn how to make money while you sleep, leave a like. And subscribe to the channel so you do not miss the final part of our Money Mastery series. The goal is always to get you more money. See you next time.